Hello everyone, this is Arif and today we are here with another unit of CIA Part 2, Unit 2, component of Internal Audit Engagement. This is a brief background of my career and professional journey. Just in case if you are interested, you can pause the video and we can also connect via LinkedIn. This is an interesting slide. It gives you a snapshot of the entire CIA Part 2 journey. I have classified the entire study units in total 14 into 6 phases. Phase 1 is about understanding the business. Phase 2 is about understanding how to plan an audit engagement. Then we move to phase 3, where we try to understand different types of controls, frameworks that are important for having within an organization. As an internal auditor, you have to understand that. Then we move to phase 4, which is understanding the business processes. Then next is about how we execute our internal audit engagement. And the last phase is about reporting. Within those 6 phases, we will be covering around 14 units or 14 chapters according to the relevance to each phase. Here we have the list of entire 14 units in CIA Part 2. Today we will be going through or discussing the Unit 2, which is component of internal audit engagement. In the earlier video, we have already gone through the basics of business in which we talk about strategy and what are the internal and external influences that impact an organization, how the organization strategy is being formed. So we discuss more the overall bigger context of a business because as an internal auditor, we have to understand the business first to build the context in which we will be carrying out internal audit engagements. And then in today's video, we will be going through understanding the key components of the internal audit engagement as a whole. And moving forward, we will be going through the controls framework, risk management process, and different business processes, details, understanding of the internal audit engagement execution part, and lastly the communication part, which is about the reporting. If you logically classify, each unit comprises 7% of the entire syllabus, and more or less 5 to 7 or 8 MCQs you can expect. In this variation, you can expect to be appearing in the exam. So this is just for your understanding and planning, and also measuring the progress that we are making under each video in these CIA Part 2 video series. It is interesting to know that in this CIA Unit 2, we will be covering the key component of audit engagement. The sequence might not be as exactly depicted here in the picture, but it is just to give you an overall understanding how logically things move side by side within the chapter or within the unit. Overall, if you look at the entire audit engagement, any audit engagement, if you take whether audit or advisory engagement, it's similar to a project where it has a start and where it has an end. Our project ends with issuing the final audit or advisory report, and it starts with the key objectives of the engagement. So the project management skills are important for internal auditors because in a year we have a certain number of audit engagements that we have to perform based on the approved internal audit plan from the audit committee or the board. And accordingly, when we perform each audit engagement, we have to manage the audit engagement in a very professional manner. We have to assess what are the activities that we will be performing, what is the objective of the engagement, the scope of the engagement, the resources required, and how we will be concluding the audit engagement. So project management skills are relatively more subjective, and it can be applied in all the engagements, which we will be discussing in the last section of this unit. However, we will be starting this unit with understanding what are the key objectives and the scope of the engagement, what are the key evaluation criteria standards. So basically, first we have to determine why we want to perform this audit engagement, what we want to derive out of this area which we are auditing, and then we will move to the criteria or the standard. By what best practice or measure we will be assessing the performance of that engagement to identify the gaps or to recommend the improvement areas. And the third stage is what are the different approaches that we can adopt to perform different sort of engagements, especially audit engagement. So there are multiple approaches that that is to our discretion, and we can decide which approach is more suitable for each audit engagement. And also during the audit engagement execution, we perform the risk assessment and we assess those risks, and to identify whether the controls are effectively operational throughout the period that we are auditing, or we have to recommend some improvement. So this is the overall key areas that we will be discussing in this unit. Starting with our first topic, which is engagement objectives and scope. This is the first thing which we do before starting any audit engagement, that we have to determine what we are aiming out of that engagement. And accordingly, we define what is our scope, and then we assess the risk in those areas, and subsequently we carried out audit procedures. So the objective is the driving force, and it gives us the direction where we have to head it on. In IIA Principle 13, it talks about that internal audit should plan our audit engagement in a more disciplined and systematic manner, which means that there should be, similar to the project management methodology, we need to have a proper documentation, proper mandate, how we want to execute our engagements. Because when we are systematic and organized, then it gives us more assurance that we will be able to achieve our objectives by the end of that audit engagement or advisory engagement. Standard 13.3 engagement objectives and scope states internal auditor must establish and document clear objectives and scope for every engagement, aligning with them with key risks and stakeholder expectations. Who are our stakeholder? Primarily is the audit committee, but again, we are not limited to that. We are also giving assurance to the top management in terms of what are the key risks in those processes, if there is a room for efficiency and effectiveness, non-compliances if there are, so highlight those gaps as well. So overall objectives is basically when we decide what we are aiming to achieve out of this audit engagement. Some engagement might be for the purpose of just giving assurance to the audit committee or to the management on the compliance related matter, regulatory compliance, internal policies. Sometimes it could be to detect or identify a fraud. Sometimes it could be to give any improvement suggestions, efficiency related to efficiency or effectiveness. So there could be different kind of objectives, but that needs to be determined ahead of time. And based on those objectives, we determine what is our scope and what are the key risks that we have to evaluate to test those controls which are mitigating those risks. The next step is to determine the scope. The scope is how far we will go in this audit engagement in order to achieve our objectives. What is the time period that we will be covering? What are the locations? Locations are more important, especially if, for example, you're doing a retail outlet audit. So how many shops? Let's presume that the company has 50 outlets. So how many you are going to cover? 10, 20, 30, or overall 50? It could be you have businesses in different geographies and different locations, or you can have a business in different business lines. For example, you have different products. So which product line you are intending to review their processes and the governance framework around that product. So these are all attributes of scope, and we determine which these things in the start of the audit engagement. There is one more element that we need to take into account, whether we are aiming for having an assurance engagement or advisory engagement. Assurance engagement, where we review the controls and the processes around those objectives, and we assess whether there are the processes are intending to achieve its objective or not, or if there are risks which the management or the company is exposed to, and which may deter the company to achieve those objectives. So we highlight those risks in the form of audit findings, and also give them the recommendation how to mitigate those risks. And sometimes the management, they have their own alternative controls. We also assess that. So this kind of engagement is primarily known as assurance engagement. In terms of advisory engagement, there could be an agreed upon activities that we can perform. Either this has been mandated by the audit committee, or sometime requested by the management and endorsed by the audit committee, that we can perform such engagement. And based on those mandate which is being given to us on the advisory assignment, we assess whether the activity is complying with those mandate or not. For example, it could be kind of review of a feasibility study. It could be of review of a process to identify what are the key control gaps within that processes, or simply could be an assurance activity. So there is a difference between assurance and advisory engagement. Advisory engagement are mainly, there are specific needs and specific requirements either by the management or the audit committee, and sometimes the methodology, the work processes which we imply is relatively different than the audit engagement. It based on the nature of the request, and even the reporting could be very different. Scope limitation basically falls in a negative term, and there is another term which you need to understand is out of scope. So the first one, scope limitation, is where there are certain areas that we want to cover in order for us to achieve our audit engagement results. The management or the environment restrict us to perform the audit procedures in order to achieve those objectives. And such kind of scope limitation, we raise it to the management, and we also raise it to the audit committee if it is unresolved. And we state clearly in the audit report, and once we conclude our engagement. But if it has such a major impact that we wouldn't be even getting close to our achieving our objectives of the engagement, then we can raise this point as an escalation to the audit committee and drop that engagement as well. Out of scope, on the other hand, which is not covered here, but from a practical point of view I want to share with you, is out of scope are the areas where generally we as an internal auditor bring into the attention of the management and the audit committee or the board that we have excluded certain areas in our engagement. So when we present the results of that engagement, especially in the assurance activity, they understand like there are certain limitations to our judgment or opinion or the findings, and it does not cover the entire overall scope. For example, there are 50 outlets of the company which we could have audited, but we just, because of resource limitation or because of any other reasons, we just opted for 10 outlets to audit. So the remaining 40 we have to classify out of scope, that we have not concluded those areas. Or similarly goes to geographies or anyway, or it's more of a positive thing where we want to not give a wrong impression to the audit committee that we have covered everything and everything is okay. So they should understand that there could be a possibility of having some risk not being reviewed, or a major risk that might expose in the areas where we have not audited in the scope of the audit engagement. So the first step which we have taken in whenever we are intending to have an audit engagement or any engagement, that we determine what is the objective that we want to achieve. The second thing is to determine the scope. The third thing is to establish a criteria. What is the criteria? Let's dive deep into the standard, and then we will discuss more generically and practically. Standard 13.4 speaks about evaluating criteria. Auditors must identify the most relevant criteria, it could be internal, external, or best practices, to evaluate governance, risk management, and control. The definition is criteria are the standards or expectation used to judge performance or compliance. That is the ought to be. So basically, criteria is nothing against which, basically it's a thing against which we measure the activity. For example, if I'm carrying out a procurement audit, so how I can state that whatever the activity that management is performing is correct or wrong, because it can be challenged. So what I do, initially I request the policies and procedures which has been approved by the board, sometime by the management, sometime by the board, and to assess the ongoing activity within that department is as per those SOPs or not, as per those policies or not, are they complying with it or not. So criteria is basically a benchmark. It could be a policy, it could be a guideline, it could be a regulations, best practices, authoritative standards. So these are all different forms of criteria. In my practical experience, I have come across areas to audit where there were no policies and procedure, or very minimal informal memos by which management was performing those activities. And the problem with those activities is that if tomorrow that one person who is doing the things in a certain manner, he leaves the company, the new person comes, he doesn't have any resource which mandate him to do things in the right manner or in a different way. So he might use his mind to do things the way he feels it is the right thing, and Sometimes people has limitation. They do not understand the overall context and the risk of doing things in a certain manner, which may expose the whole company in different difficult situations. Therefore, in such situation, what we are doing, that we take what is the best practices, how to manage those activities, and we benchmark their current practices with the best practice unless they have their own internal policies and procedures. So this is another way. We also look into authoritative guidelines. For example, if there is a law which mandate that thing to be done in a certain manner, if there is any regulation that they have to follow, and those also become kind of the criteria or the standard against which we assess the performance. There are certain qualities of good criteria, that it has to be relevant, aligned, measurable, practical, and clearly documented. So here we are with another section. So in the first section, we discussed about the objectives and the scope. In the second section, we discuss about the criteria or the standard against which we measure the auditable activities. The third one is the risk management process. So the principle 9 states that the internal audit should systematically plan our audit engagement and link those audit engagements or audit plans with the organizational risk and long-term objectives. So basically, whenever we are intending to have our annual audit plan, we see what is the relevance of those plans to overall achievement of the organizational objectives, and we assess what are the risks that that can lead the organization to derail from their achieving their objectives, and those areas we generally pick in our risk assessment. Because as an internal auditor, we have limited resources, limited time, and we want to use our limited resources and time and skills in the most optimal manner to serve the company to achieve its objective. Standard 9.1, understanding the risk, states the chief audit executive must understand the governance, risk management, and controls to develop an effective audit strategy. And standard 13.2 states engagement risk assessment. Auditor must identify, evaluate, prioritize risk relevant to the engagement, focus on areas of highest significance. As I already mentioned to you, that our plans are basically, we try to make it more aligned and relevant towards the organizational objectives, and to give an assurance on areas that may significantly contribute towards the achievement of the organizational objectives. There are certain things or certain terms that we are supposed to understand in the risk management process. We generally use these technical jargons quite often as an internal auditor. The first one is inherent risk. Inherent risk is basically whichever area you are auditing, inherently how much it is exposed to the risk. For example, inherently, in most, or in fact in all companies, finance department is inherently very high risk, or accounting department is a high risk, because the money is involved here as compared to HR department. They are risky, but not inherently as risky as finance department. So exposure, inherent risk, this is in the overall context, and inherent risk in the process context is basically when we review a process, we assess whether inherently how much this area could be more exposed to the risk. For example, if you do not comply any controls, I will give you an example. For example, you have diamonds and you put it on your table. So this thing is inherently high risk, and based on the inherent risk, we determine which how much controls are needed in that area and how much assurance or testing we have to perform in that area, correct? As compared to you have, let's presume, a $10 candy and you place it on the table. So inherently, it's not that risky. Even if you lose it, it's not worth enough that you should be bothered, correct? So inherent risk is basically when we do not assign any control. So how inherently that area could expose a risk to the company. Residual risk is when you place the controls in such activities and the leftover risk is basically residual risk. I will use the same example. For example, you believe that the diamonds are very precious and you have to safeguard, so you put a vault, you put your diamonds in a vault, okay, and you place in a secret place, or maybe in a corner in your house or somewhere, right? So do you believe like this much control is enough? But still there is a risk that someone can break into your house and take the whole vault out, correct? So you have to decide based on your risk appetite how much control is justifiable to place to that activity. It might be that these are the most rarest of diamonds in the world, so what you do, don't place it at home, you place it in a more secure place and you put it in a room where there is some biometric to enter, and you place cameras, and then you place a security guard, and you have an alarm system, automatic emergency system, because they are very rare diamonds and it's very expensive. However, you will not do all these things, for instance, for a candy. It's a very lame example, but I just want to give the concept to you that what is the difference between inherent and residual risk. So residual risk means that the risk which is left over after you place the controls. So this is the second terms which you need to know. The third one is control risk. Control risk is basically you place the control. For example, you put your diamonds in a vault or in a safe, and the key to open doesn't work out. For example, it doesn't lock, so anyone can open the vault as long as they can have access. So it's mean the controls are not effectively working, so the control risk is high. But if the controls are very stringent, they need a key and you need to place a certain code, and you might need a fingerprint to open that vault, then it's mean that the controls are very effective and the control risk is low. So control risk is basically how effectively those risks are being mitigated by those controls in day-to-day activity. So these are the three terms which you need to understand, and this is very core to our audit activity, because when we carry out our audit engagement, we look into each activity from these three perspectives. Inherently, how risky it is. What are the control risks? Control risk is basically after we tested those controls. And then residual risk. Does the residual risk justify the cost benefit of having those controls or not? So this is the three terms which you need to understand. In order to assess the risk in any process, we follow certain steps to ensure that the risks are properly managed in those activities or not. The first thing is to set up the context, then identifying the risk, assessing the risk. Then the fourth is the response, how we mitigate those risks, and the last one is monitoring. The first one, context, is basically, for example, you're doing an audit of recruitment process. So whenever the company intend to hire someone, you have to build the context, like what are the things that they are aiming for, is there is any regulation they have to comply with in terms of hiring, what is the minimum age they have to give to or offer to a candidate, what is the age limit of the candidate, if there is a gender biasness in the recruitment. There could be certain criteria to fulfill by the HR, mandated by the HR in terms of their policies, procedure. For example, the candidate needs to be a graduate in a respective discipline, certain number of years of experience, certain kind of a qualification. So this is all variables that give us the context. For example, when I was working in the aviation sector, in that company, there were certain nationalities that were being barred from being employed in that sector due to some security concerns. So people overseas or expats, those are from certain nationalities or countries, they were being barred to be hired in that company. So there could be different things, and that was done. That list was being provided or mandated by the regulator itself as the national security concerns. So there could be different elements that we have to take into account when it comes to setting up the context. The second thing is identification of the risk. So in recruitment, if you look into it, what is the risk that we hired the wrong candidate with the wrong experience, with the wrong qualification, the behavior is very bad, the person has a criminal background, the person has defaulted somewhere. So these are different kind of risk that hiring process could be exposed to. We might not be complying with certain regulation or policies and procedures. So this is the first step, that we identify all sort of key major risks, and then we reassess those risks in terms of what is the likelihood and the impact of those risks in being in being materialized, in being exposing to the company. So the risks which are less likelihood, has less impact, we might not perform too much test on those risks, or we take a small sample and we perform very minimal test. But the risk where there could be high likelihood, high impact, we have to perform more stringent testing and to assess those controls in those areas are more effective. Sometime there could be certain incident which could be less likelihood, but they can have a major impact on the entity. So we might also take it as a high risk areas, and we have to perform audit procedures more stringently in order to give assurance on those activities. The next step comes that what the management have the controls to mitigate those risks which we have highlighted. For example, does the company disqualify or does not even, they have a preventive control to not even entertain an application if it is for a minor which is less than 18 in certain areas, if it is of certain nationality. So they have built in the job application certain questionnaires or certain criteria to eliminate certain people, those who are not graduate, those who doesn't meet the experience requirements or qualification requirement. And we have to see that the management in deciding the response to those risks are mainly into 5 categories. Sometimes the management accept the risk. For example, the management say, because we have limited skill set of professionals in the market, so we might compromise on certain criteria. they just accept it. Or sometimes they avoid it, they disqualify anyone who doesn't qualify for those criterias. The other approach, which is reducing the risk, is where they identify that the candidate is there, but with certain training they give them in orientation certain training to best meet with the job requirement. This is different kind of reducing the risk methodology. The fourth one is they transfer the risk by outsourcing such activities to an outsource firm to carry out those activities rather than full-time hiring. So in that case, they transfer their risk. Either it could be of recruitment or getting the services from a third party for those activities where they cannot feel or where they cannot get the right resources. And the last one is just to pursue without looking into whether they have to treat that risk in any manner, as long as if it is in risk appetite and within tolerance limit. So these are the 5 strategies management perform. Either they accept the risk, they reject the risk, they avoid the risk, they reduce the risk, or they just simply pursue those risks. The last thing is monitoring. So these risks today might be they might not expose the company today, or the risk profile of those activities might change over the time. For example, there could be a risk of financial liquidity risk, which initially was not there because the banks were giving loans at lower interest rates. There was more liquidity in the market, but suddenly some economic activity which happened globally, and there is a credit risk, there is a liquidity crunch, and as a result, the company cannot have access to short-term loans at the desirable interest rates. So eventually that risk become exposed. So with the changing situations, risk is not a static thing. That with the change in environment, internal, sometimes external, let a risk to fluctuate from being minor to high, or from high to being medium or low. So we have to keep on monitoring, and based on the change in environment, and we have to even need to change our risk response accordingly. So this is the 5 steps risk management methodology, which is generally being taken by the management to perform their risk management activities within the company. The first one is to establish a context. The second one is identifying the risk. Third one is assessing the risk. Fourth one is the response, how they will mitigate those risks. And the fifth one is monitoring. The role of the management in the risk management are following. The board basically set the risk appetite, which means that how much the company can absorb the risk. So they set certain limits, financial and operational limits, and which give us a benchmark or a standard or a criteria against which we assess the risk within the company. And the management are supposed to own and manage those risks. And internal auditor, we provided assurance on those risks, whether those risks are being effectively managed through controls or not. So this is different roles of different stakeholder within the company in regards to risk management. In terms of determining the audit engagement, we have primarily 4 different types of approaches. The one is traditional, in which we follow the entire audit cycle, planning, execution, and reporting. The second one is agile, where the circumstances does not allow us to effectively plan that area, maybe because of lack of policies and procedures. Maybe that area is very unique to that company and industry or sector, which cannot be benchmarked against any established criteria. So in such cases, the internal auditor can have the discretion to start the audit and then decide what should be the scope by performing the walkthroughs, by meeting with the people and assessing the risk, and then determine the scope and the timelines and frequency of meeting with different people, and also on the outcome. For example, when they are intending to issue the findings, maybe it's a very critical area, so on the go you highlight them, the key findings, rather than waiting for the whole engagement to finish and then issue a final audit report. So this is more flexible and agile, as its name is an approach that internal auditor can take. Integrated, where we do not focus on in our scope only one department, but rather we focus more on the processes. For example, procure to pay, where we might request information and assess the controls in different departments. For example, inventory, procurement, then credit control, finance, accounting. So a lot of departments we request information, and it's more cross-functional rather than performing audit on finance department as a whole. The remote one is basically very simple. It's the same like traditional, but it is being done virtually. All the information request is requested remotely, and interviews are conducted virtually. It is good, but again, it is not applicable in all situations. For example, if you have to carry out warehouse audit or fixed asset physical review, you have to perform on site. So these are 4 different types of approaches that internal auditor can take into account when planning the audit engagement. Whenever we are planning for remote auditing, we have to take into account that we ensure the authenticity of the information that we receive from the third party or the second party from the management. Also, we need to understand that there is a loss of human connection, because when you meet with physically, there is more warmth, and sometimes people open up and they share quite meaningful information which they might not share with you when you remotely connect with them. The third one is attack failure. So you have to have a good backup plan for having like proper internet connection, software, security, and all. So these are certain things which you have to be mindful whenever we are intending to have a remote auditing engagements. Just to have a quick recap, in the first section we discuss about setting up the organizational objectives, determining the scope, then we move to establishing the context, then we discuss about what are the key risks and activities and how it is being managed through risk management process, and what is the role of different stakeholders in the risk management. Then we move forward. There are different approaches to engagements that internal auditor can adopt. Now we are discussing about, as a whole, the entire audit or advisory engagement as a project management, under the project management. So basically, whichever engagement you take, whether audit, assurance, or advisory, is basically constituted as a project which has a start and end. So we can apply all the methods, and we can take into account all the key key measures to control that project and execute in a more effective way. There are certain constraints, like any other project, to internal audit engagements as well, that if we want to cover a big scope, then it will take more time and it will cost us more in terms of resources. Or we could be focused more on the risk, limit our scope, then it can be effectively carried out in a shorter period of time, and might cost us less. If we deploy more resources to a project, Again, the cost will increase, but the time will reduce. The scope could be more effectively controlled. If we apply more time, then obviously the cost might increase. I mean, the scope could be coverage as well. So there are different dimension to each project, but we have to be more cost effective and optimal in a way to, when we determine our scope, we take into account the time constraint and the expense or the cost constraints. Similar to any other project, we have in initiation, in engagements, we carried out planning, we execute the engagement, we review, control, and monitor. Monitoring and controlling through be that once we issue the final audit report, we review the findings, or it could be taken into a very specific context of audit engagement, that throughout the audit engagement we review that are we extending our time, or does more resources required, and what are the corrective measures that we have to take into account. And the last one is closing. So what is our final deliverable audit report, advisory report, or a follow-up audit report? So that is the closing, and how effectively we communicate those results through reports and on a timely manner. So it is similar to any project that when we perform our audit engagement, and we can apply the same concept to audit engagement as well. Project management artifacts and tools. There are certain things that we can take into account in carrying out a project management activity. The first thing is organizational process assets, which means that what are the tools that we can use and which are mandated by the organization, such as in our audit engagement, the risk and control metrics, the opening meeting presentations, the audit program that we use, the draft report and its template. So these are certain tools that we can use, which are mandated by the department or by the organization. The second thing is the environmental factor that we need to take into account, like in terms of the laws, the culture, the technology that we might be accessing through for achieving our objectives or carrying out the audit activities. The third thing is project management plan. For example, how we schedule our activities, the role and responsibility of a manager, of a lead auditor, of a junior auditor, which is a RACI document usually used in the RACI document, which are used in the project management. Risk registers and the risk, basically what are the key associated risks that can derail the project from achieving its objectives, and the communication plan. There are certain key attributes that we can instill in order to achieve a project management, in ensuring that the project deliverables are clearly defined, the milestones are clearly defined, there are proper role and responsibilities, and the individual who are involved, they know what to do and what their responsibilities are. Time box sprints reviews means like periodically we review the progress of the project management of the ongoing projects. And the last one is the risk and issue logs with the status tracking. So what are the challenges that we are facing in internal audit? Generally the challenge is sometimes the management try to limit our scope, sometimes we have scope limitation. We might also have difficulty in getting the time from the management, getting timely the information from the management delay the process, they do not acknowledge things, we can have a disagreement with the management. So there are different kind of challenges. Those challenges needs to be highlighted and resolved on a timely basis in order to achieve our objectives. So these are certain key aspects of project management that we can use in our internal audit engagement as well. This is the last slide where I try to comprehend all the sections and to give you an illustration of a procurement audit and how each section can have a role in or the activity that is supposed to be performed. For example, in objective and scope, we can see in procurement audit, just take an example that we have to request them all the requisition, but we have to review all the requisition, purchase order, payments, see whether the procurement department is in compliance with the policies and procedure or not. The second element is the evaluation criteria, in which we can take companies' policies and procedure, applicable laws and regulation, apply benchmarking process of three-way matching in our procurement audit engagement and audit procedures. The third thing is the risk management process. Identify what are the key risks in different procurement activities. Some of the key risks are the selection of a vendor, whether it is being selected with the proper criteria or not. Do we have a vendor management list, vendor master list? How we evaluate the vendor? Do we blacklist the vendor? 3-code. For example, whenever we are intending to buy, do we reach out to 3 vendors and assess their performance, vendor evaluation, technical, commercial evaluation, and then we can see who raised the request, which department, the purchase order, payments. All these things, we can see that what are the key risks with those areas, and how the controls are performing in those areas, and then accordingly we can test those controls. So risk and controls matrix we can use in that part of the audit engagement process. Then coming to the approaches, we can see whether we can use a traditional or agile. Most likely I'll go in procurement audit with more traditional approach, or it could be virtual, remote as well. The last one is the project management guidelines. We can apply those guidelines in our entire procurement audit engagement. So this is a brief snapshot just for your memory. It is not required to understand in this manner, but it is just to give you a good perspective of each and every area that we have discussed in this session. Here we are at the end of our presentation, and in this presentation we have covered the CIA Part 2 Unit 2 component of the audit engagement. We discussed about the audit objective, the scope, the criteria, risk management process. Then we discuss about or different types of audit approaches, in which we cover mainly 4 approaches: traditional, agile, remote, and one more. Traditional, agile, remote, yes, cross-functional. And lastly, we cover the project management techniques, in which we establish that the internal audit engagement can be performed as a project, and we can apply the project management techniques to our audit engagements. With this video lectures, I will be also sharing with you in the description column. You can find the link to download the notes, and that will basically that reflects the same topics, or it covers the same topic that I have presented in the presentation for your quick review. Thank you very much for watching it, and hope to see you in the next video with another unit. And till then, take care of yourself, and I wish you good luck in your journey. And please do not forget to remember me and my family in your prayers. Thank you very much.